不懂了。
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
What's going on, guys? Welcome back. Happy Friday to all the Zcash near hype believers. Ladies and gentlemen, we are ripping. We are ripping. Robbie is at a family graduation event, so you guys will be rocking with me all day. Happy Friday. We are live from the financial capital of the world. You're watching the Rollup. Today is Friday. May 22nd. We have a great show ahead. Before we get into it, shout out to our friends at Plume. We are at the Nest by Plume. Let's give them some love. They're doing a great job. They got their Bermuda license. Plume's crushing it. Stoked to be in the office here in the Empire State Building. Ladies and gentlemen, we are at the Tokenization Tower. We got Chainlink God joining the show. He is going to be talking about the billions of dollars migrating to Chainlink CCIP following the Kelped Out incident. We got Upshift and Superstate calling in as well. And Franklin Crypto, head of their new Franklin Crypto division, will be at the Nest. And then we also have the AI Supercycle with Relayer Capital founder Austin Barak, good friend of mine. Also been very, very right as of late with his theses and with what he's seeing in the market. Let's get right into it, guys. Before we do, let me tell you about Frax, our premier stablecoin partner, building the future of digital money, open, stable, and borderless. For more information to start using the future of digital money, visit frax.com. It is a beautiful day in New York City, 65 degrees. Partly cloudy, but man, it's sunny. It was supposed to be a rainy, shitty Memorial Day weekend, but I think we're starting strong. Not so sure how the rest of the days are going to come, but today was amazing. Walked outside in the morning, got a nice sandwich, coffee, and went for a little walk, and it was just perfect weather. Perfect weather. So, I mean, it's hard to not be happy about the weather when Hyperliquid's at all-time highs, Zcash flying, Nears ripping. We've been harping on these for a while. They keep doing well. The weather is powered by our friends at Relay. Relay.link for your favorite cross-chain swaps and anything else in the digital asset landscape. Let's keep it rolling into our friends at Near. We are powering the show with our new tokenized equities partner, Denari. Bring them up. Infrastructure for tokenized equities and bringing real world stocks on chain. Do more with your stocks with Denari. Ladies and gentlemen, the market is looking pretty damn good. We need Bitcoin to hold this level, this 77 level. What's up, one arm bandit? What's up, my dude? Get in, send it, pump it, hodl it. Just don't miss it. Man, good to have you back, man. Bitcoin, 76.9. We need to hold this level. If we don't hold this level, it's going to be hard for the market to really be able to get more out of this hype Zcash Near trade. Near at the bottom at 2.17. I mean, we were covering this thing before we left on our conference trips, and it was 1.3. It was at 1.3. And so, I mean, look, I know people want to get, the 100x and all of that, but Near is wildly undervalued still and doing quite well. Solana just holding that 86 mark. Chainlink up a little bit as well. ETH and Bitcoin just continue to kind of mull around. Don't really have an understanding or a reason why here. I'm honestly not paying that much attention to either of them other than just making sure and hoping really that Bitcoin holds that 77, 80K level. Man, if we get any action on Bitcoin, like I mean anything, the slightest hit, things across the entire market are going to fly. Today's digital asset market prices are powered by our friends at Zama. As always, visit zama.org to learn more about their confidential transfers and confidential private payments with their new Zama portfolio product coming out very soon. All right, guys, let's get into the news. Before we do, let me tell you about our premier AI partner, also ripping face Near, the blockchain designed for AI native applications and autonomous agents. Start developing today at near.org. Use near.com for their multi-chain confidential intense product as well. Let's get into the news. We had Zama today come out and say over the last couple of days, I believe this dropped a couple of days ago, Zama acquires TokenOps. TokenOps previously handled about $2 billion in distributions, vesting, and compliance flows, but they did it all publicly. Zama integrates FHE, fully homomorphic encryption, plus ERC 7984 confidential token standard to make auditable unlocks, airdrops, and token allocations in a private fashion. This is huge. Play the video. There's an institutional angle here designed for token managers as well. RWAs needing confidentiality without leaving the safety of public blockchains. Again, guys, Zama is leading this shielded narrative. They are an absolute slept on team. Of course, a partner of the show. However, they are slept on in the privacy space. This acquisition of TokenOps further deepens their ties into the actual use cases: payroll, payments, token unlocks, airdrops, distribution, vesting. All of this is going to have to be private in the future of this on-chain economy. Zama's doing it. I think the token is undervalued. I think it looks great. If privacy is getting a bid, Zama and Zcash will probably be doing quite well. That's Zama, that's TokenOps. Let's keep it moving. Our boy Michael Saylor is honestly not leaving me with much hope. I mean, I just, wow. Just play the video. This is just unreal. Unreal.
Let me recap the
Unreal.
Q&A.
Yeah.
Too good to be true, bro.
Let me tell you about Bitcoin. Turn it up. Business as usual, candles go red. Timeline screaming, we just nod our head. Business as usual, no despair. All we really want is Bitcoin per share. Not too fast, not too slow. Let that orange engine go. Not too fast, not too slow. If the stack keeps growing, let it flow. Digital credit, digital flame. Old Wall Street still learning the game. They say, wait, how you pay that yield? We say, Bitcoin, baby. Check the
Bitcoin,
field.
baby.
To be true,
Let me tell you about Bitcoin.
too good to be true.
Hard as money, no Bitcoin. Bitcoin per share.
This guy owns the most Bitcoin in the entire world, the largest corporate holder.
As usual.
Orange everywhere.
Yeah, they call it magic, not as math with drip. Orange coin under the whole damn ship. Waves hit hard, but we don't bail. Flex don't fail, ride that gale. They panic sell, we calculate. They refresh charts, we educate. They ask, is this some kind of trick? Nah, bro, it's credit with a Bitcoin kick.
Do no harm, protect the chain. Flex through pressure, rise again. Do no harm, protect the chain. Run it back, run it back, run it back, run it back,
run it back, run it back.
Let me tell you about Bitcoin.
Too good to be true.
Hard as money, no Bitcoin. Business as usual.
Bitcoin per share.
Business.
All right, I've had
as
enough of this.
usual.
Oh my goodness. AI generated recap of strategy retail investor Q&A. The Q&A recap. Where's the yield come from? Bitcoin, baby. Okay. Fong Lee, Natalie Brunell, Saylor, absolutely polarizing the entire video content landscape, saying that basically Wall Street is assuming that this stretch product is completely and utterly Ponzi-like, and Saylor's description and explanation for it is Bitcoin, baby. New Type says, now we wait for Zcash versus Bitcoin AI music fiddle. Oh my goodness. Man, this Zcash being the better Bitcoin narrative is definitely interesting. So I wanted to talk about that because, I mean, this guy is the biggest holder of Bitcoin in a corporate treasury fashion. And the meme ability is just, it's kind of unreal. It's kind of unreal. Like I would not have expected Saylor to come out with anything similar to that at all. So, this is like the internet culture taking things to the next level consistently and memifying, being a steward of financial capital, memifying to the max. I don't have much else to say. All right, we're going to keep it rolling into Jane Street and some quants. Before we do, let me tell you about Infinify, our local DeFi partner building DeFi infrastructure for simpler access to on-chain yield, liquidity, capital allocation. To learn more about efficient on-chain finance, visit infinify.xyz. So our guys at Jane Street, these are the types of quants that you're competing against trading in the stock market. This is why, I've crashed out after trying to trade commodities and just fully back all in on the big major Zcash hype near. Let's play this video.
Running big models to in the middle of making trading decisions.
I think the thing to understand here is there isn't one time horizon. There are many time horizons. There are trading systems we build and trades that we do where in order to be competitive, you actually have to turn around a packet in under 100 nanoseconds. And like, that's a very different regime, right? People sometimes talk about like, oh, can you guys write high performance stuff in OCaml? It's like, we can, but like for this kind of speed, it's like, it doesn't matter if you write OCaml or Rust or C++, you can't use a CPU, right? You are going to be on an FPGA that's like direct wire attached to the network, and you're going to be turning around the packet so fast that if you like attach an oscilloscope to the wire on the way in and the wire on the way out, you would see the packet start to leave before it's done being consumed. So it's like a very different, very specialized regime. But like when you're in that time regime, you really can't do very much computation. The decisions you're making are going to be very simple. And in fact, there's this kind of whole curve of trade-offs between how smart is the decision that you're making, be it a model or some other kind of maybe even like handwritten decision-making process, and how fast the turnaround is. And like the right way to build an optimal trading strategy is really to have a kind of ensemble approach where for some kinds of decisions, you're making very simple decisions very quickly. For some kind of decisions, you're operating at the scale of, instead of thinking of 100 nanos, maybe like a handful of mics or tens of microseconds or hundreds of microseconds or milliseconds. And in some cases, there are processes where if you can get that decision turned around, in an hour or that day, that's totally fine. And you're kind of competitive on a time basis at each of these horizons, but you're making very different kinds of decisions at all of them.
Maybe you can't say, but what is it exactly these models are predicting? Like surely just not the next thing in the order book, or maybe it is.
Right.
All
so
right,
we're definitely like dancing towards stuff that's hard to talk about. But I think the simplest and most important one that we've been thinking about, like we think about it now, but like also 25 years ago when I started at Jane Street, when I was building like models out of linear regression, and stuff like that, like a very useful kind of thing is to predict a fair value for a thing. Like what do we think this thing is worth? And that fits in a very kind of composable way into lots of different trading processes. That's not the only kind of thing that we use as a prediction target, but it's an important one.
Yeah. So I'm just glad that Jane Street is out of this market because they were nuking Bitcoin at 10 a.m. every day like clockwork. Pretty much every day like clockwork. And they're now out of it, and they are not nuking Bitcoin every day like clockwork. They are not. And I'm glad that they're not, because they were always every 10 a.m. shift in Bitcoin, they were nuking the market. And now they're not, and it's better. Bullish 00, Zcash is private, quant proof, and still have a chance to be a neutral asset for sovereign funds. Bitcoin is tied heavy with USA, so other countries may be hesitant to invest in BTC. New type. Interesting. Your favorite stocks are now tokenized, crushing at 10 cents a time. Simply amazing in one arm. Yeah, they are. They are. And they're coming on chain. So pretty excited for that. All right, let's keep it rolling. We've got, I think Polymarket got drained. 660K, compromised internal key. Platform says that there's been no smart contract exploits that users have to worry about. In these instances, I always kind of tend to just want to pull back and pull out of smart contract platforms like this. So not what you want to see from the world's largest prediction market. But I did make $100 last night on Kalshi. Let me just check that actually. So I took the Knicks to win by over 5.5 points. And I put 100 on it. And bang, yes. I got 194 now. So let's go Knicks. Great win last night. I am not going to gamble that tonight because that's how I will lose it. Just for the Knicks. So, All right, guys, we've got Zach Rynes, the leader of strategic initiatives at Chainlink. He's going to join the show next. And Zach is a friend of the show. And he is a longtime partner of Chainlink and community supporter. So we're going to get Zach up. Before we do, let me tell you about LeFi, building infrastructure for cross-chain swaps, bridging, routing across the on-chain economy. To explore smoother cross-chain execution, visit lee.fi. Let's get Zach up. He's going to be our next guest here, live from the Tokenization Tower at the Nest, powered by our friends at Plume. It's been a crazy week in the markets. It's been a wild month for Chainlink. Let's get Zach up and let's get him started.
Hey, Andy.
Alrighty, Zach. What's going on, man?
It's doing well. How about you?
You must be busy, man. It's been a wild month.
Yeah, to say the least. I mean, it seems like everybody's getting hacked. It seems like what's happening with AI. I don't know if that's what's accelerating it, but across the industry, it feels like it was a flood. I think April was the biggest number of individual exploits in that month alone, which is just absolutely crazy to see.
Yeah, I mean, we just covered Polymarket, had an exploit today. I saw another one on a bridge earlier, TAC Finance. I mean, it's every day. And you know what it feels like, Zach, is that it feels like it's just like these old, less taken care of GitHub repositories or code bases that, these protocols have a couple $1 million in TVL or something, and they just haven't updated the code base or thought about it or touched it in a while. And it just feels like there's this all-knowing intelligence that is just seemingly scanning across all of these potential honeypots and just looking for opportunities and just picking opportunities down like flies. It's just a really weird dynamic.
Yeah, I feel like there's different categories. You have definitely the projects that are, it's a bit of a bear market. There's not much development support going on. They don't have a lot of security assurances going on, and people find bug exploits in code that's been deployed for years, maybe AI assisted. But then you have a category of teams who don't have proper operational security, and you just see private key compromises happening left and right. And I think it's insane that in 2026 that a single private key getting compromised can destroy hundreds of millions of dollars in value, but that seems to still be happening in our industry. And I think that's the biggest shame, is that these were private key exploits are preventable issues. Code exploits, you can do audits, you can try and protect around it, but things happen. But private key compromises, there's really not an excuse for those situations.
Yeah, man. I mean, obviously, what happened to Layer 0 about a month ago has led to a significant kind of reshuffling of the cross-chain landscape with regards to quite a few different teams porting over, notably most recently, Turtle Club, to using Chainlink CCIP. So I'm just curious, man, from in the last month, take us through what's been happening behind the scenes, talking to teams, talking to security researchers, talking to founders who want to secure their cross-chain landscape. What has been happening from the Chainlink side over the last month?
Yeah, I think the Layer 0 exploit was really a wake-up call for a lot of the industry. I think a lot of people never thought or really looked into the differences between different cross-chain infrastructure providers. But I think, over the past month or so, we've seen about $4 billion worth of cross-chain token value migrate from Layer 0 over to CCIP. That's teams like Kraken, Lombard, Solve, teams who have these tokens that are worth, in some cases, billion. KelpDAO themselves migrated over to CCIP. And I think that people are realizing the difference in security philosophy that these different infrastructures provide. Layer 0 is a bit of a ad hoc, do-it-yourself, you configure it, you can secure it yourself, which can work if you're an experienced team, but a lot of devs are not cross-chain infrastructure security experts. They just want a bridge for their token so they can distribute it across multiple chains. They'll stick to the defaults or whatever is recommended to them, and when the defaults are unsafe, as the Layer 0 team themselves have said, they're unsafe, then that leads to just immense centralized points of failure. CCIP is designed fundamentally differently. It's secured to be secure by default. Every bridge lane is 16 nodes, native rate limiting, multiple layers of defense implemented into the network by default. And if you want to add additional security and configure it, you can do that too, but you're not expected to be a security expert just to use CCIP. So a lot of these teams, they saw the layer 0 exploit and they started to review their own infrastructure and their own bridge security assumptions, and a lot of them are reaching the same conclusions, that infrastructure that they thought was secure was actually not secure. And when they evaluated the landscape, it was obvious that CCIP was the secure by default solution, that they didn't have to spend time, money, resources trying to build their own infrastructure when there's already a secure solution. So a lot more of these teams are reaching these conclusions, and they're shifting their infrastructure stack over. So that's been the major shift that we've seen over the past month, and more teams continue to reevaluate their security posture. And it's not even necessarily just cross-chain. There's been price oracles that have been having issues over the past month. Chaos Labs was compromised. Pith just went down for 4-6 hours this morning. Like, multiple different types of infrastructure providers across data and cross-chain have been having issues, and Chainlink keeps operating as it always does without incidents. Cross-chain transactions keep processing. I mean, at this point, Chainlink secures over 110 billion in value. I mean, that's 70% of DeFi plus 60 billion in cross-chain tokens. So it's dominating the market value and the DeFi TVL markets by a large margin.
Yeah. And I think right now I'm seeing some reports that DeFi insurance is now pricing layer 0 3 to 5 times higher in terms of insuring the cross-chain architecture than Chainlink CCIP. I'm just curious, like, how much more risky are a lot of these other Oracle designs than Chainlink, like, realistically? Like, is 3 to 5x fair for those names that you've named? Like, let's just be objective here, right? Like, I know big Chainlink bull, but like, when it comes to pure risk understanding and analysis, what is the right way to think about the risk spectrum in oracles right now?
Yeah, I think there's one of the primary differences is that when you're integrating with a Chainlink Oracle service, you're getting a strong security floor. You know what your security assurances are. They're standardized across all integrations. So if I'm a token that is integrated with CCIP, that security assumption is the same across all CCIP enabled tokens. So if I'm an insurer, or I'm a market curator, or I'm whatever kind of DeFi operator, and I see a CCIP integrated token, I already know what the security assumptions there are. I don't need to do a lot of due diligence. I just do the due diligence once, and the model's the same for everyone who integrates with that infrastructure. Infrastructure like layer 0 is fundamentally different in that because it's do-it-yourself, bring your own security model, you can't just assume that every integration is the exact same. You have to analyze individually each integration, which becomes very difficult because when you're configuring a bridge, you have to consider every chain lane, every connection between different chains as an attack vector. You just need one bridge lane to be compromised and the whole token can be exploited. Infinite min attack, a bridge contract getting drained. The RS-ETH issue was just one bridge lane between Unichain and Ethereum. You only need one chain lane to get compromised. So you need to not only investigate and due diligence in every single little configuration, you need continuous monitoring because it could change at any time. That configuration that was one way on Wednesday could be completely different by Friday. So you need to have this continuous monitoring, which for markets that are listing hundreds of tokens, it's not super practical. So the best risk reduction move is just to have more conservative risk parameters for that asset. Whereas with CCIP, you don't need to worry about that because you know it's a standardized security model across all integrations. So that's a huge difference. And just in terms of numbers, a lot of the bridges that are operating on layer 0, KelpDAO was a 1 of 1, but a lot of these bridges are 2 of 2, which is not that much better, particularly when CCIP is 16 nodes by default. So CCIP is 8 times more decentralized than the default configuration of layer 0. And even the best 4 of 4, which we've seen some of those bridges come out, that's still 4 times less decentralized. Like there's not even a single layer 0 bridge that's half as decentralized as CCIP. So you have to take these things into account when you're analyzing the risk of a token. You can't just consider, market curators will look at liquidity, they'll look at volatility, they'll look at, the supply distribution, because those are all economic risks when you're lending and borrowing and using assets in DeFi. But the bridge risk is significant. Like that could completely zero out a token or cause it to become under collateralized, even if it's like a crypto commodity native asset. So these are all risks that market actors and insurers and curators have never had to really consider before, but now they're being forced to consider. And the most straightforward path is you have to put a discount on riskier, more ad hoc infrastructure that's much harder to monitor over time.
Yeah, I mean, I think that's what the market is kind of adjusting to. That's why we've seen this migration, and that's why, you know, these larger node architectures have been, you know, were the output of the initial smart contract era. If you remember, Ethereum's claim to fame has always been the most resilient, immutable blockchain. However, we kind of went through this phase of time where we took it to a logical extreme on the other side, and we ended up, you know, frankly, with something that I'm extremely bullish on, which is Hyperliquid. But all Hyperliquid is a 16 node blockchain, right? A lot of them in Asia and Tokyo, and it's a great product, extremely performant, amazing technology. But it's like the whole industry went down the path of performance and UX over decentralization. And I think there may be kind of some steps back from there. Even Lighter, as an example, for a perpdex, has very interesting, or just launched very interesting ZK technology, allowing effectively emergency escape hatches without the need for the actual, you know, admin key or multi-sig, et cetera. And so I think that this trend is like ever growing, this kind of like returning back to the other part of the spectrum. And a lot of these things, Zach, are actually, as with anything, specifically in crypto especially though, and in crypto investing, the path dependencies become very, very clear in hindsight, right? Like this event is very clearly a path dependent event that is going to favor a more, a stronger outcome for Chainlink. You know, and it's just like, you couldn't have, sure, you know, you've been harping on this, but until it happened, it wasn't so obvious that Chainlink was, you know, in a stronger position. And so I'm just curious more about like a longer term outlook, understanding the spectrum, understanding like how kind of path dependencies affect investment performance, affect the way that industries are really just created, right? Like this event has ramifications on the way that this industry is going to evolve. How do you anticipate this kind of broader trajectory within the industry, and then as well as Chainlink's specific position as it pertains to this kind of path dependency, returning to fundamentals kind of event that's happened? How do you think about this going forward?
Yeah, a trend that we have seen historically is that in a bull market, it's move fast, land grab, got to get the users, got to get as many chains as possible, got to expand. And security, reliability often takes the backseat in those situations, unfortunately. And a lot of the users, they might not be the most technical or the more sophisticated, they don't need to be, but they don't necessarily realize that there are corners being cut, that there's been compromises made. And unfortunately, some of that infrastructure is able to obtain market share, and then an incident happens, like the layer 0 exploit, and now all of a sudden everyone realizes, okay, security is actually an important property, particularly in an industry where the whole value proposition is automated programmatic finance. If there's an issue in this automated financial ecosystem, that creates cascading effects, and then you combine the composability of DeFi with that, and it creates contagion, and now you have the whole ecosystem at risk. And that's the biggest risk of DeFi is not even necessarily like token prices, it's that there's some dependency that breaks and causes a cascading failure. That's the biggest risk by far. And I think going forward, security will be in heightened importance, particularly for infrastructure. But I think the way the industry is moving is that while DeFi has played a very important role in the past, I think it's pretty obvious now that institutions are stepping in. Stripe has their own blockchain. DTCC has their own blockchain. And when these infrastructures are looking at what Oracle infrastructure they want to use, what cross-chain infrastructure they want to use, they're going to look at the historical track record of these infrastructure providers. So I think that reason alone puts Chainlink in a very, very good position. I mean, just a few weeks ago, we saw DTCC announce that they're using Chainlink's infrastructure for 24/7 collateral management on their DTCC collateral app chain. And that was in large part chosen because of Chainlink's historical track record, in addition to its platform of services. But I think that institutions, their bar for security and reliability is just exponentially higher than anything in DeFi, and not because DeFi doesn't care, but it's because they're managing trillions of dollars in assets. They manage quadrillions of asset flows and volume per year. Like they have to care, because if they don't, all of society is at risk. And so their stakes are much higher. And then you throw the compliance and the regulatory liability risks on top of that, like they're going to prioritize security. So like, you know, Chainlink getting integrated with the DeFi protocol, that could take a day. You know, you kind of just swapping some contracts. Getting integrated with a TradFi institution is like a multi-month process because they have to, you know, cross dot the I's and check the check boxes and look at the compliance sheets and like make sure that you have the right certifications and the right audits and like it's a whole thing. It's a completely different world out there. So I think as the use case of crypto is become finance and moving assets and trading assets and financial applications, and the obvious next step is to bring more traditional assets on chain. You know, the SEC has the exemptive coming out for tokenized stocks. You have more and more equities, money market funds, all these kinds of financial products coming on chain. All of them are going to look at what's failed and what's worked in the past and apply that to their own strategy. So I think Chainlink's probably the best position from a security reliability perspective by far.
You know, Zach, I think I totally agree, right? And I think a lot of people agree with that. And I think the only thing that people are fussed about is $4 billion in transfers from layer 0 to Link as far as the infrastructure transfer, Kraken, Solve, Lombard, yet the token barely moved a couple percent. Like what's the investment thesis for the holders? Tokenomics are not looking aligned with usage. People are really just looking at how is this thing not moved, you know, with the likes of some of these other assets. Why after all these years of success is the Link, the asset, still not being prioritized by leadership or by the community or by the team? And like, what really is the investment thesis here? And I think if you zoom out, it becomes clear. But, you know, speaking to the community here, speaking to the holders, how do you rectify this massive migration that's happened, that's going to continue to happen with kind of not a strong reciprocal effect in the token market?
Yeah, I think that Link as an asset is relatively difficult for a lot of people to understand, because when you look at like the top 30, top 40, everything's pretty much a blockchain or a stablecoin. And people understand what a blockchain gas token is, how that's used. People know what a stablecoin is. It's not really an investment, but like that's the other asset. Chainlink is the only non-chain infrastructure within the top 50. And unlike chains like Hyperliquid, which is fantastic, don't get me wrong, I love Hyperliquid, but all their revenue is on-chain, and everything's programmatic and visible on-chain. Chainlink's economics are fundamentally different in that it's not just dealing with on-chain value flows, but also signing enterprise deals with banks. And so that requires a completely fundamentally different economic model that requires the ability to take in fiat payments, convert that into Link, and use that towards the network operation. So it's like a fundamentally different economic model that no one has seen in the crypto industry before. And I think a lot of people have a difficult time wrapping their head around it. But I think that the market will eventually catch up and understand that the fundamental value that Chainlink provides is undeniable, and the value capture is not any different than infrastructure we already see on the market. I mean, Hyperliquid, the most prominent example. What's their economic model? They generate revenue, they buy back their token. It's fantastic because they make a lot of revenue, and it's a great case study. Fundamentally, the Chainlink model is not any different. You pay for services in Link, you pay for services in non-Link, it's converted to Link through a buyback model. Staking will continue to expand. Link itself is a store of value, just like every other crypto asset in the space. So, you know, people have different stories that they tell about different assets in the space. But at the end of the day, what really ultimately matters is that you create a product that's good, that people want to use. You're able to obtain dominant market share. You're able to monetize that market share, and then you're able to apply that monetization back into the token. And I think where Chainlink will really shine is as institutions continue to step in, because that's where the money is. Like, DeFi is broke, unfortunately. Like, a lot of the monetization that's taken place to date has been through chain integration deals, and that's worked very successfully thus far, but there's not an infinite number of chains. The real moneymaker is coming in and doing rev share deals and different kind of deals with institutions as they increasingly come on chain, and then that gets diverted and flows throughout the system through these different economic models. Like the actual economic value distribution flow is like a solved problem. It was solved like 150 years ago through buyback programs and, you know, dividends. Like that's how you accrue value to an asset. The hard part is creating a useful product that has lasting staying power that people want to use, people want to pay for, and becomes the standard. So like it's been, I think it's taken longer than most people, even myself, has anticipated to get to this stage and get, you know, I thought 5 years ago everything would be a smart contract. You know, I thought everything would be on chain many years ago, but you know, it turned out to be a little bit more nuanced than that situation. But I'm still fundamentally bullish on the idea of blockchains and smart contracts. And ultimately, like if crypto, blockchain, smart contracts as a technology wants to succeed, it needs a platform like Chainlink. Otherwise, if Chainlink doesn't succeed, neither does the concept of smart contract applications, in my opinion. So they're kind of, these destinies are intertwined with each other. And in the short term, markets are irrational. I mean, I just point to XRP, and I still don't understand where the market's heads at with some of these coins that have nothing going for it other than the memetics and the cult community, which is valuable, but it's just you can't really quantify the value of that, but it still exists. So that's kind of where I'm coming from. Obviously, I would be a beneficiary of seeing Link do well, but I have strong conviction that the market will recognize the importance of Chainlink.
Yeah. Are you of the mind that this growing situation in the market of, look, this token has this fundamentals, this revenue, it has this many flows, it has this much emissions, this token is such that the net value flow in terms of the plus minus here, right? So the plus being revenue coming into the asset, and the minus being effectively everything from unlocks to emissions to inflation to team payments to salaries to payroll, etc. Are you of the mind that the market is starting to really accept this net token value flow with regards to, hey, we're going to analyze assets based on their emissions, based on their plus minus, and kind of like a debit and credit outlook towards these assets? Do you see that as being a very sticky part going forward in this market, like a sticky way to invest and think about these assets? Is it really this plus minus kind of credit and debit way of assessing whether a token is investable or not?
Yeah, the way I look at it is, who is going to be the next marginal buyer and what is their model going to look like? And I think retail is dead currently. That money's not coming in. It may come back, but you never know what that's going to trigger that. I didn't think it was going to be NFTs, but that's what happened in 2021. But I think the next marginal buyer are more of the institutional archetype. They're going to be looking at the flows, they're going to be looking at the revenue, they're going to be looking at the value accrual model, and they're going to want to see a model that makes sense, even if it's not necessarily net positive inflows in the short term. If there's a model that works in the long term, and really it's effectively only two things: some kind of dividend, which is a staking reward, or some kind of buyback model, which is just a buyback model. It's the same in crypto. And are you able to achieve the monetization and the network effects required to get that flywheel engine running? I think that's going to become increasingly important, and I think a large reason why Hyperliquid is going to keep getting more and more attention, because it's such a straightforward model, and especially as they continue to expand into TradFi, and TradFi recognizes Hyperliquid. That model of it generates revenue and buys back its token is just intuitively obvious, and I think more and more projects are starting to shift towards that direction. Chainlink took that model and applied it to not just on-chain revenue, but now also off-chain revenue as well. So I think there's a lot of different ways you can actually take this economic model and explore it. But I think the idea that my token is money and people are going to use it as a store of value, I think that story is dead for most assets. It works for Bitcoin, kind of works for Ethereum. For everything else, it's dead. That story of being a meme coin, I don't think is going to entice the next marginal buyer. In my opinion, personally.
Yeah. Zach, one of the things that we've been really pushing on the show is, look, we've been thinking about this industry in that lens that you kind of speak on with the next marginal buyer, token value accrual, token flows. But we've also been extrapolating that and that concept into, well, the reason why is how you said, right? It's the institutional allocators, it's people that think about these assets in a certain way. But what also is happening is a lot of us have been thinking about the industry for the $100 billion on chain, $3 to $4 trillion in the total market cap, and that all the DeFi protocols, exchanges, oracles, lending markets, et cetera, are all just for crypto assets. But very obviously that kind of notion is being shattered in front of our eyes, right? This industry is building an alternative on-chain ecosystem for tokenized assets of all types. And so the scale that we're talking about, goes from a couple $100 billion to a couple $100 trillion, relatively quickly when you start to think about it. And so I'm just curious, Zach, how your current mental model is shaping up about how to think about the investable opportunity and the framework for an oracle like Chainlink, a DeFi protocol, a lending market, a DEX. How are you thinking about heuristics for valuing these protocols and assets in a future of hundreds and thousands of different types of tokenized assets on chain to the tune of trillions of dollars on chain, right? I think a lot of our mental models will be shattered in terms of sheer scale. How do you reconcile thinking about where the industry currently is, where we're probably going in about 5 to 10 years on chain, and how to kind of like value these things?
Yeah, I think the market historically has been very biased, and honestly still is biased towards the fat protocol thesis that the L1 blockchain, because it's the base layer, is going to capture all the value. We can see that just by the insane price sales ratio of pretty much every L1 compared to how much value it captures today. And just the relative, like I mentioned, every coin in the top 50 is basically a blockchain for the most part. So the market thinks that that's going to be the central area that accrues value, but I think Ethereum is a bit of a warning story that that's not really the case. Ethereum at one point was the cash cow making billions a month, and not so much anymore. Now who makes all the revenue? It's the apps and it's the vertically integrated chains. You know, it's the pump fund and the hyperliquid, as well as the asset issuers like stablecoins. Tether is an obvious story there. So I think it's clear that the idea that everything would accrue to this base layer just isn't really the case. You need to be able to control the economic flow, and you need to control the users. So like anything that's able to capture MEV has done relatively well. So, you know, Chainlink has Chainlink SVR for capturing MEV revenue in that sense. And being able to work directly with the client, you know, something that's trying to be a credibly neutral, generalized, anyone build on me chain can't really set up enterprise rev share deals, right? Like if Lighter's building on Ethereum, that's fantastic. There's no rev share between Lighter and Ethereum. Lighter pays a little bit in DA and proof verification, and that's all Ethereum gets, and Lighter keeps all the revenue for itself, right? Whereas with Chainlink, because it has this organization associated with it, it can go to Swift, it can go to whoever, and establish a rev share deal and sustainable economics that work. Like, you know, there's deals between Chainlink and GMX that are rev share deals. So like you have to be agile when it comes to the economics, and I think it's becoming increasingly clear that the apps and the front ends that control the user flow is capturing more of the value because they have the leverage, and the middleware infrastructure that's able to abstract away the increasingly commoditized blockchain ecosystem is also set to benefit as well. So that's not a super popular view. At least I don't think it's popular, because look at the market valuation of all these L1 gas coins on the market. But I think the market's increasingly recognizing that you can be an L1 and succeed, but you can't just be a generalized smart contract chain. You need to have your own native perp dex that has trading fees. You need to have your own stable coin that has interest on reserves revenue. You need to have rev share deals with your interfaces. I mean, look at Hyperliquid's builder codes. That was genius of a distribution strategy, and they've made them and their partners a lot of money through that strategy. So I think the market's starting to wake up that you can't be passive on the economics. You need to actively, aggressively either capture the user and or establish rev share deals with the apps that have the user capture. And I think that's something that as more and more assets come on chain, tokenized funds, commodities, securities, natively issued securities come on chain, it's not going to be any different. You know, the venues that people are trading on, the apps that people are using, the middleware infrastructure that institutions use to connect to 100 chains easily, like that's the infrastructure that is able to accrue value. And then the next commoditized L1 EVM fork, like I just don't understand why that still gets funded in this market. Besides retail or VC wanting to sell tokens on retail, but why is retail buying these tokens? I think that they're going to be the last ones to catch up, but I think the next marginal buyer understands that this is shifting.
Yeah. I mean, we've seen that just in the market performance. Like Zcash is getting a bid. It's like this private store of value. So there's clearly like this, like, there's still like a appetite for like this like store of value, no utility other than just like reflexivity. And then obviously Hyperliquid, and then some like AI stuff, right? But you know, I think David Hoffman just crashed out and like sold all of his ETH, he said, and then like Bankless had like some weird like I don't know what happened with the company, but some like weird like just like dichotomy of opinions between them two, I think maybe you could say. And a lot of people are just like nuking on ETH as well in general. I hold some ETH, not really a lot. I don't know, like Santiago Santos is on Empire again today saying that 255 billion is like way overvalued for this thing. And now you're telling me that, you know, your view on a lot of these L1s is like, you know, they're commoditized or they're commoditizable and they need perp dexes, they need stable coins, they need revenue, etc. Has your view on Ethereum changed? And has your view on ETH, the asset, changed?
Yeah, I mean, I used to be definitely a bit of an ETH maxi in the past. What really sold me, and I'm not ashamed to say this, was the ultrasound money story. The idea that Ethereum would be adopted and that would lead to revenue and directly lead to a deflationary native coin. It was a story that just made sense because it directly connected adoption to token value accrual in a very direct way. But now that Ethereum's revenue fell off a cliff by like 99.9% because they shot themselves in the foot. They took the most valuable part of the stack, which was MEV, contention fees, and congestion fees, and forfeited that to all the L2s to capture, and then focused on the least monetizable part of the stack, which is data availability and settlement. They kind of shot themselves in the foot in that regard, so that ultrasound money narrative completely died. And at this point, I've talked to quite a few like Ethereum people, and the pitch is essentially, well, as the Ethereum blockchain gets more adopted, ETH is going to be used as a store of value in DeFi. Like that's a given assumption, which maybe it will, maybe it won't. I don't think that's necessarily a given assumption that ETH will be a store of value that people will use, particularly as more and more tokenized assets come on chain. Those markets are denominated in stable coins and tokenized deposits. No one's using ETH. Hyperliquid doesn't use ETH as the currency, it uses USDC. Same with Lighter. Lighter uses USDC. They don't use ETH in any way, not as a store of value and barely as a revenue generating asset. So the story's just kind of changed for Ethereum. I think that the way that Ethereum can make up for it is either it's able to psyops people into believing it's money in the same way as Bitcoin, which, look at Zcash. It's done a fantastic job of doing that. It's not an unviable path. Or it's scaling the L1 aggressively and generating fee revenue through volume, like just immense amount of volume. But it's kind of in this weird path where it's trying to scale the L1, but it's just not where these other new generation chains are. It's trying to be a store of value, but it's just being dominated by stablecoins instead. It's kind of just like this identity crisis mode and then the EF, I don't know what's going on.
What's going on there, man?
I wish I had an inside
just
view.
Left?
Yeah, I don't know what's going on there. They brought on Tomas. I thought things were going well.
Same. Him
and a lot of other people left, and now it's back to the idealism that's been running the EF for a very long time. I don't know. I was starting to get bullish when Tomas came in and the whole, focus on pragmatic adoption and build what users need, and now it's back to what they were doing for the past few years. And so I don't know what's going on there. It's and I don't think what's happening with Ethereum is necessarily unique to Ethereum. I think this actually applies to a lot of other L1s. The difference is that Ethereum's worth $200 billion. So it's going to be held to a very high standard. It's the same reason I talk about XRP, not because I really care, it's because it's worth so much relative to what I think the fundamentals are. There's a long trail of L1s that have problems way worse than Ethereum. It's just that they're valued, relatively speaking, to reflect that. So I think that there's a changing of guard happening in the industry.
There is, man. And honestly, it feels like, I'm obviously back biased here, but it feels like Hype, Zcash are kind of part of that in a big way. We're making a ton of money on one side, and, this entire industry was built for trading. Here's a great trading platform. We make a ton of money. Arthur Hayes was on the show yesterday. He's obviously, left, right, and center with his takes, but he was look, I was an exchange owner. Exchanges make money. We know this. We know this is something that makes money. Things valued. It depends on the market caps or how you look at it. But, and then you got something like Zcash, which is just privacy, Bitcoin, getting to be quantum resistant. And so I don't know, it's just weird that I find it interesting that the rhetoric right now is around only a couple assets. And also it feels like everyone's just forgotten about the old guard of the L1s and L2s. I don't know, it's healing in a way, but also depressing in a way, because a lot of these teams are still going to just keep building and working. But the market can be so cruel in the way of new asset, good asset, new trend, new narrative, good trend. And there's just been such an explosion of assets, and consolidation is just the only way that makes sense in the industry going forward. And that's going to be a bit of a brutal reality for a lot of the industry.
Yeah, I think the pendulum always just swings from tokens are amazing, we need 1 million tokens, to tokens are useless, we don't need any tokens. And we're kind of in the maybe a few tokens. And I think we'll kind of swing back. But I think that bifurcation of your project needs to have fundamental value to be taken seriously by the next marginal buyer. I don't think that dynamic is going away. And I think it's healthy, because some of the biggest issues with crypto in the past is that garbage was funded with billions of dollars for years, and there was no incentive to build useful things if you could just launch a project, sell a token, and then do it again 10 times over. Like there's no reason to build anything real, and the projects that were building something real, like I think Chainlink is, kind of gets ignored by the wayside because it's not the big new shiny thing anymore. It's just building financial infrastructure, which is kind of the whole point.
But that's going to come back. That pendulum's going to swing back, I think, as well.
I think so. I don't think it's going to be like 2021 where everything just goes mayhem. Maybe. Seems very unlikely. But I think the idea that it's only like 2 coins that are going to succeed, I think it's going to be a little bit more than that. And it should be, for industry successful, we need more than just a trading dex and a privacy coin. Like we need, there's a whole lot of other use cases we could do with blockchains. You need things to trade on Hyperliquid that have value. So I think it's kind of just one of those temporary reflexivity of hyper volatile crypto dynamic. It's 4-year cycle stuff.
Zach, thanks for your time, man. Have a great long weekend. I'm sure it's going to be a nice little break. We'll see what happens over the weekend. I'm sure there's going to be some antics. There always are. And pleasure to have you on.
Appreciate it. Thank you, Andy.
Cheers, Zach. All right, buddy. Man, Chainlink just continues to get into the right spot at the right moment and continues to just get where institutions are going to be placed in the right spot at the right time. As I was saying with like the path dependency side of things, it's really how this industry works. You get very path dependent outcomes based on events that are far out of your control, and you're either on the right side or the wrong side of history. Pulling up the chat here. Greetings from Bulgaria. Plume belongs in the top 10. What's up, Christian? Feels like another example of Uniswap, new type. I don't know if they're on the IR page. Didn't like that answer as much. I had to ask that for you though, new type. Guys, if you're on YouTube, I'm watching the chat. I will ask your questions. We've got Aya and Fig from Superstate. Aya is the co-founder and CEO of August Digital, powering Upshift, and our lovely friend Fig is a core personnel from the Superstate team. And they have just launched a new product called Upshift Clear. It is instant redemptions for money market funds. I used money market funds this year for the first time in my life after selling a lot of crypto in 2025. And I learned this year that it does indeed take +1 settlement to get out of a money market fund, and that was an annoying learning. So we're going to talk to Aya and Fig. Guys, welcome to the show. Good to have you. Welcome to the Rollup.
Andy, thanks for having us.
Thanks for having us. Good to be here.
Yeah, so did you guys hear that little analog there of my money market story as a fully on-chain investor for 6 years trying out a brokerage account? Terrible. Absolutely awful.
I'm glad you sold at the right time. One of us
did something right.
I was going to say, hope you're holding hype though.
Yes, of course. Been bullish for a while. Good to have you guys. It's good to have you back. Fig, first time on the show, man. Would love to hear a little bit about yourself before we get into this. What do you do at Superstate? And does Jim ever dunk on you in basketball practice or no?
No, I don't dare step on the court with him. I wouldn't let that happen, but I'm sure he could. Great to be here. Thanks for having us, guys. I am on the business development team at Superstate, leading our protocol relationships and working with great partners like Upshift. So been there for a little bit, been around the crypto world, tons of different types of crypto companies, and excited to be at Superstate and working with Upshift.
Yeah, beautiful. Well, I think last time you were on the show must have been 4 to 6 months ago or so. We were talking about kind of this tokenization growth and how Upshift was really positioning for that. We'd love to just get caught up on your side. What has Upshift been up to the last 4 to 6 months? I know obviously this kind of tokenization wave, if you will, has significantly increased in terms of things actually happening as well as attention. How have you been capitalizing on this? Catch us up until the Clear announcement.
Yeah, so again, thanks for having me. Great to be back. I would say at a high level, vaultification is still very much here, and it's for all different types of products, and it really is a capital raising initiative. And so why we're super excited about Superstate is if you look at, I think it's no secret, you mentioned you sold all your crypto, back in 2025. DeFi more broadly, TVL is down roughly 30% year to date, but RWA TVL is up 50% roughly. And so if you think about where capital is going, it is going into those money markets. It is going into more institutionalized products and RWAs in whatever facet. But to your point, it's really, really painful to have T+1, T+3. And so how do you really create that flywheel with the 24/7 market by having the instant redemptions, by allowing for, seamless, accessible liquidity both in and out? And this is one step in that direction.
Beautiful. All right. USCC has been growing significantly, Fig, and you guys have done a good job. Why does this make sense? Why is this kind of unlock with Upshift clear? What does this provide to Superstate customers, clients, and kind of how do you think about this evolution of the seamlessness of these RWA products on chain, the core benefits there, obviously being 24/7 instant redemptions, which we now have. How do you kind of think about this at large?
Yeah, USCC has been phenomenal this year in terms of growth, and it's been a really interesting product. What's interesting about Upshift Clear and why it's important for USCC is it typically takes T+1 market days to get out of USCC. So if you redeem on Thursday at 4 p.m., you're getting your cash back on Friday morning. Upshift Clear is a great sort of use case for weekend liquidity and after-hour liquidity. I think it gives investors a lot of comfort of when they can use these RWAs, what sort of applications they can use these RWAs, knowing that there's liquidity 24/7 behind the scenes, ready to be used in a protocol like Upshift. So we've got a ton of really interesting clients. Bitwise is actually coming on as the asset manager for USCC. That's new news, which is awesome. And Upshift is giving investors and future investors a lot of comfort of how they can use this product and how quickly they can go back to cash.
Love it. And then could you just break down how this Clear Vault works from USDC deposits into the instant redemption functions? How exactly does this work?
Yeah, absolutely. So, behind the scenes, this is the first time that we've launched our Atomic Redemption Vault. And so what happens is we have a number of different LPs. We've raised now interest in over $100 million of LPs that are comfortable and willing to underwrite a number of these RWAs. We're starting with USDC, but looking to expand across a number of different Superstate current and future products as well. And so really what happens is there's two sides of the market. There's the market from the LPs. They deposit into the vault. They lend their liquidity. They get the receipt token on the other side. The liquidity goes into safe yielding assets with instant liquidity capabilities. And whenever on the other side a redemption comes in, that Atomic Vault will essentially atomically withdraw the funds, redeem plus fee the redemption request, and then the LP itself, in terms of the RWA, will then be manually processed through a redemption cycle with Superstate directly. And so obviously, that's a first step for us to making this fully atomic across both sides, and also to support a number of different RWAs. Like I said, we're super excited about the different tokenization mechanisms that Superstate has, both for the products they have today, but also there's so much interest in expanding the RWA footprint more broadly and to tokenize more existing assets and bring them into this 24/7 ecosystem. So we're very, very excited about expanding, what this instant redemption vehicle can support.
And then somebody has to, you mentioned through Superstate, there's kind of the reserve management here. Somebody has to take the actual assets into a money market fund and then also process the redemption there. Given that these things may happen on a long weekend, like, this weekend here, how do you guys compensate the LP or the holder of this product? Right. So let's say I go and, Friday at 4:45 p.m., I'm like smacking the exit. I get my 100K out of this product instantly. The LP of that money market fund of that 100K theoretically wouldn't be able to pull that out of a brokerage even until like Tuesday, and then they would not be able to get those funds until like Wednesday or Thursday. How do you reconcile the difference of time and the yield that is like lost or generated because the product is still in that fund, but the users already pulled their funds out? How does the reserve management work?
Yeah, it's a great question. So if you're looking at, for example, overnight, then I would say average market, both demand in terms of what people are willing to pay and looking to get paid is around 2 bips. If you're looking for some of these larger weekend plus holiday timelines, I would say it's closer to 5 bips. And so the goal is obviously to make that pretty dynamic. I think on average, it's closer to 3 bips just based on the volume that goes through and then the time at which it's requested. Now, again, that can extend to be more dynamic over time, depending on the duration. Right now, the duration that we're looking at is really just T+1 and then weekend. Great question. So that fee is currently paid by whoever's looking to instantly redeem. So, that also has to make sense on the other side in terms of what someone's willing to pay in order to, get that 24/7 liquidity. There's always a wide spectrum of how price sensitive someone is. And there's always the long tail of when people want to get out most is typically, market cycle or black swan event, and they're looking to rebalance and they're, maybe willing to pay more than in a market like today. And so I think that price scenario is very dynamic, but currently really just keeping it within the 2 to 5 bip range, depending on the time at which someone's looking to redeem. And again, just for the T+1, T+3. But that's exactly right. We basically are just the vault infrastructure provider. You have the LP that's getting paid the fee on the other side. They're taking on duration risk. And then the redeemer who is looking to get that instant liquidity.
And Fig, are you seeing real demand from Superstate USCC, clients and customers and holders for this? And, who are those archetypes of people or firms that actually, care to have something like this?
Yeah, there's a lot of variety in USCC clients. We see stablecoin providers, issuers who are looking for yield behind the scenes. We see DeFi native hedge funds that are looking to enter into the carry trade themselves and don't want to trade it. We also see high net worth individuals who are pretty active in their DeFi positions and actually using RWAs. I think that second and last bucket are perfect examples of users for this product. People that want to move positions as they see new opportunities come on chain, people that are rebalancing for market opportunities or just changing market conditions. So just getting started, and we're excited to have Upshift as a partner.
Yeah, and then Fig, do you think that this is going to be possible for other products in Superstate's kind of repertoire? Like I know that there's the USTTB or US. Yeah,
USTB
I might be.
Is our treasury bill fund. That was our flagship money market fund, which we launched over 2 years ago. It's been really fortunate to have a really liquid product there, but we've launched a new product line called FundOS that's allowing existing asset managers to bring their funds on chain and for us to tokenize them using our technology. And a lot of these asset managers, they don't have the same T+1 or T+0 liquidity. And I think this is a great use case for Upshift Clear, is enabling investors to take on new exposure on chain, holding it in familiar infrastructure, but having the peace of mind that they can get out when they need it.
Yeah, anything to add there as far as like other potential types of products that could be useful in a vault structure like Upshift Clear with instant redemptions?
Look, I think at the end of the day, there's a price that someone's willing to pay to take on duration risk of any asset. And so it may not necessarily all live in the same vault or subset. I think, what we've seen is obviously, USCC is a different type of risk profile than some of these tokenized fund structures. And underwriting those really depends on the risk, and pricing it also depends on different risk. And so I think that we'll probably see a subset of different risk profiles for different duration. You've seen 90-day duration, we've seen 6-month duration, and there's always a price that someone's willing to pay to put that on their books. But it is really exciting to see that come on chain, because historically, in order for you to be able to, get instantly in and out, you would probably have to OTC this with, for some of these more complex products, you'd have to OTC it with a prime desk, you'd have to be onboarded there, you wouldn't have great price discovery, slippage would be crazy, you'd probably pay enormous amount of fees just because, again, you're desperate to get in and out of a situation like that. And so bringing that on chain is going to hopefully, one, make it a lot more transparent, two, hopefully make it cheaper, and three, enable you to get access to the 24/7 credit market, which, for example, Morpho and Aave supply. And the only way for you to do that is to have, collateral that you can actually liquidate. There's a secondary price for. So I think we're super excited about this. And then there's a lot going on, on some of the more interesting pieces for price discovery, where it's, we talk about like ETFs, we're talking about commodities, like IPO products. I mean, there's a lot of interest in some of these RWAs and tokenizing them and bringing them on chain. Superstate is leading a lot of that charge. And so, yeah, we're super excited to see how we can plug in that liquidity venue within these different products to make them more accessible and usable on chain.
Love it. Last thing about the product, then I want to talk more broadly here. Question from one of the listeners is USCC a product that's open to anyone, KYC, accredited investors only? What are the requirements to be able to participate in this vault with USCC?
Good question. That guy's doing my job for me, so thank you for asking the right questions. USCC is a private fund. It's only available for qualified purchasers, so investors with more than $25 million in assets and above. So that's USCC today. We've got more coming in the Fund OS pipeline. Just announced a fund with Coinbase Asset Management called Cushy. That's a stablecoin lending mandate, and we're excited to bring more on.
Beautiful. So guys, I had Carl from 6 Man Ventures on, I think it was on Tuesday, following this innovation exemption potential rumor from the SEC, talking about the rules for tokenized equity specifically. And I think the crux of it was essentially you have to have the dividend rights, shareholder rights, voting rights, full kind of rights that a typical stock or equity would have off-chain, on-chain, to be able to potentially offer these on trading platforms or venues. And the other kind of big thing was you can tokenize equities without direct permission from the issuer themselves. So third-party issuers can kind of tokenize these equities. And so we had this conversation about the different types of models, native versus wrapped equities, and kind of like how this works. And through this, we kind of came up with this tokenization barbell, which is like often a word that is used in crypto investing. And we came to the idea that there was like these very highly useful parts of the tokenization stack, and they're kind of on the opposite ends of the risk curve and of like the liquidity curve. And so on one side, you've got tokenized deposits, stable coins, products like T-bills and money market funds. And on the other side, you've got equities and kind of like very liquid tradable products. And in the middle, where it's not so likely to have a lot of value, were things like venture capital, real estate, or these types of kind of like more illiquid mark to market once a quarter, twice a year types of assets. And so that was kind of like the framework that was laid out by Carl. And I'm curious how you guys are thinking about this tokenization evolution. We've thought about it, Rob and I, on the show, as we started with like the most high quality, non-speculative assets, tokenized deposits and stablecoins obviously grew massive, and then T-bills, money markets, and now we're getting into equities and other products. So we're kind of thinking of it as like an evolution. But as far as like the value proposition of tokenization itself, do you guys align with this spectrum concept? How do you both think about where tokenization actually provides real value to a given set of assets? You can probably take a stab first.
Yeah, so first off, major shout out to Carl from 6 Man. We love him. And I would say Fig is probably the expert on this, but I actually will push back on the barbell and frame it a little bit differently. I think it depends on what perspective you're looking at it from. Are you looking at it from the asset issuer, or are you looking at it from the user who gets access to these products? From the asset issuer perspective, the best piece of feedback that I've received is actually the barbell is as it pertains to OpEx and cost. And so if you look on one side, you have money markets, and then if you look at the other side, you have private credit. And that's because those two things are either where you can have cost savings, but the in-between of like ETFs, index funds, these are products are almost today offered at cost. And so there's no real OpEx savings that you would have by bringing them on chain. And so, when you're looking to make a difference, at least internally at these very large organizations, you're trying to save some sort of operating cost. That's the convincing factor of bringing these on chain, in addition to net new markets that you're selling into. So that is kind of the barbell for the asset issuer. Now, I agree with you in terms of the barbell for the user themselves, right? At what point did the tokenization really help? And so in my view, I think one of the things that we're seeing a lot of demand for is directional underlying exposure to these assets. And so, as you talk about how do we bring tokenized equities on chain? How do we bring more commodities on chain? But also indexes and ETFs. We're not recreating the wheel here. Folks just want a basket of goods. They do not want to make the decisions on how those baskets are rebalanced and made. And the issue is, again, that's what the user wants. But the asset issuer is here saying, well, it already doesn't cost me anything to put this in the traditional market sense. Why bring it on chain, especially when the regulatory overhead is going to be so expensive? And so I do think that, at least from the, user that is looking to get access to these assets, I agree with you on that barbell. And it really just pertains to then once it's on chain, what do you do with it? And so how do you make it composable with the rest of your portfolio? I will say one thing that I think is we're going to see a lot more of is, if you look at just what happened with the pre-IPO tokens, Cerebras was one that, saw significant liquidity on Hyperliquid. And what was so crazy was that I believe the pre-IPO price on Hyperliquid was roughly 6% away from the actual IPO price. And so people were able to express an opinion prior to it hitting the IPO price, and that is what people want access to. And so then how do you make that composable with the rest of your portfolio? People are going to move to where the 24/7 market is, where they can express opinions. So I think at some point we meet halfway, but it's definitely going to come on chain because that is just where the liquidity exists for you to trade 24/7. And if Hyperliquid and TradeX IC are an example of that, that's where the liquidity exists today.
Yeah, Fig.
Yeah, well said. I think a lot of people are looking towards crypto capital markets and they're seeing $320 billion of stablecoins to compete for. And I think that's a really exciting opportunity. A lot of the products that I've seen personally that came on were a result of market demand. Treasuries for stablecoins, commodities after gold and silver running up. I think equities right now because there's actual interesting companies going public and creating innovation in public markets. So will be interesting to see where we go next, and it's really exciting.
Yeah, I mean, I agree with both. I think that there's different ways to approach where the value is, who is actually getting that value from the different perspectives, and kind of the general kind of mental model that I think is being shattered in the space right now is that we're building this entire industry for just the $100 billion on chain of crypto assets and the $3 trillion of the market cap that exists. I think that entire notion is being shattered into, well, no, I mean, we're going to have tokenized versions of dozens and dozens and hundreds of assets on chain from non-speculative to speculative. And the total kind of TAM here is starting to look more a lot like chipping away at bits of global finance rather than just kind of this little crypto ecosystem that we've built over the last, 10, 15 years. So Fig, Aya, you guys are fighting the good fight. Appreciate you guys joining. Have a great long weekend. I'm sure you guys will have some nice time away from screens, hopefully. And thanks for coming on.
Thank you for having us.
Happy Memorial Day.
Yeah, happy Memorial Day. Thanks, guys. Alrighty. Ladies and gentlemen, we've got the institutional segment. We've got Christopher Perkins, a U.S. Marine veteran, former banker, now leading Franklin Crypto, also a big fan of the show that he runs on Unchained. We're gonna get him set up here in the Tokenization Tower, and we'll be right back. Don't go anywhere. This one will be great.
Money, power, and money, power, and we get deep, you know we get deep, you know we get deep, we get deep, you know we get deep, we get deep, we get deep, we get deep, you know we get deep.
Attend the Davos of Web3.
See you next year!
2nd and 3rd of June at the Louvre Palace in Paris. You know
We get deep. We get deep. You know we get deep.
Tokenization Tower. I'm here with Chris Perkins, future head of Franklin Crypto. After the recent acquisition news, Chris, welcome to the tower. Great to have you, man.
Thanks, Andy. Thrilled to be on, man.
How about those hyperliquid ETFs? Those caught a lot of people off guard.
Yeah, I mean, congratulations to the issuers. Hyperliquid is doing awesome.
Yeah.
And what they've really done is they've come real out of nowhere. They've been around for a while for crypto natives, but what they've done is they've come on to the mainstream set. And why? Is because 24/7 markets.
Yeah.
Like crypto natives like us, that's what we do. We operate 24/7 markets. Now I think TradFi is realizing, if I don't have 24/7, I'm obsolete.
Yeah.
And I've been talking about this. Like I'm an old futures guy.
Yeah.
And you ever hear about the Bund futures?
Okay.
So there's this famous contract. It's called Bund futures. They traded in the Life Exchange. And, all these sweaty guys were raising their hands and trading in the pits. And then Eurex developed electronic markets. And then all of a sudden, one day, everybody woke up and all the liquidity moved. Wow. And so in traditional markets right now, I think there's a lot of fear because they look at what happened. And really, this is like, you saw the news about CME and ICE, raising concerns to regulators. This hits heart to people in the derivative space because they've seen this happen already. And 24/7 is table stakes now. It's the new electronification. And if you don't have a solution, you got problems. But look what's happening. Like CME is having this partnership with Google. ICE is now, they went long, they invested in Polymarket. They had this deal with OKX. That looks like it's going pretty well. So, I mean, it's like an arms race right now. But hats off to the Hyperliquid guys. They've been doing great.
Into Bitwise, right? In 21 shares. I mean,
Yep.
It feels like all the other issuers just kind of missed the ball here.
Yeah, it's still early. I think, ETFs are a wrapper
Right.
in a way like tokens. And what makes me crazy is people have been going around saying, I don't think there's any value in tokens. That's just like saying there's no value in ETFs, right? It's not about the ETF wrapper. It's about what's underneath, right? And so I think we're still early in ETFs. I think you're going to see, as traditional finance and crypto come together, conversions, you're going to see all types of new interesting products, seeing the first concepts around like prediction market ETFs. You're also going to see, so many different innovations. I mean, you're going to have crypto native products that have ETFs that become crypto again and are tokenized. And so, we're at the beginning,
full loop,
right? We're at the beginning of this thing, not the middle or the end. And yes, I think in crypto now, retail sentiment's all terrible and people are rage quitting, whatever. Retail comes, retail goes, but those institutions, they're marching forward. And they bring a lot of capital, a lot of weight. Doesn't happen overnight, but it's happening.
Yeah, and I mean, it's also just kind of setting a new guard, right? Like people have been bullish on Hyperliquid for a while. I mean, they've been bullish on Bitcoin and majors for a while, but out of nowhere, you've got like Arthur Hayes saying Hyperliquid Zcash near. You've got David Hoffman sells all of his ETH, and people are like up in shambles about it. They don't know how to react to it. There's like this weird, how do you kind of reason about this changing of guard? Because on one side, you've got, fundamentals, revenue, buybacks, people want real value. And then on the other hand, the kind of privacy stuff happening feels like a returning to the fundamentals of the industry of kind of like why we're here.
Yeah.
And it seems like we lost both of those over the last couple of years. And so it's like a natural reverb back to where we maybe should be. Like what's happening?
I tweeted about this yesterday. I took a little bit of flack, not too much, but what I said essentially was that in certain cases, the frontier is being settled. And when you look at the frontiersmen and women, the early adopters, people like you and me that have been in for years and years, they want a certain sugar rush, right? They want to take that risk. when regulation is against them and they're like fighting the good fight. That's what really gets them going. And frankly, if you can operate in those environments and you're on the river, there's a ton of opportunity, a ton of upside. It's a different risk profile.
Yeah.
And so I think for some of the more mature assets right now, like Ethereum's been around for over 10 years. That's one of the real reasons why it's appealing to the boring institutions, because when I was in TradFi, I needed 10 years of risk.
Yeah.
And so for some folks, they're like, well, I want something that's like cutting edge and edgy. Is privacy edgy right now? Absolutely.
Definitely.
How many exchanges banned it last cycle because you're afraid about going to jail? I mean, even if you develop the stuff, right?
Yep.
So they're looking for that next frontier, and that's an amazing place to operate. But and when I step back and I look at Ethereum, I'm like, wow, what's its big moat? What's its differentiation? It's decentralization.
Yeah.
Right? It kind of is crops. And so if the EF is espousing ideals as a nonprofit, okay, that's what nonprofits are supposed to do.
Yeah.
Like let Joseph Chalom, let Tom Lee go out and do the BD. But I think a lot of it has to do with and yes, price action is always a challenge. But price action, is really down to like one reason. You know why the prices are where they are? It has to do with the number of buyers and sellers, right?
Always.
You need buyers, the thing's going to go up. Why aren't there buyers? Well, there's a few things going on. I think retail's pulled back. Some of the buyers, that old buyers have sold. They're like, I want to go on to fresh pastures, new excitement.
Definitely.
You've got the institutions marching. You got a lot of geopolitical pressure, that's keeping risk assets down. But generally speaking, crypto is showing a lot of resiliency despite the pressures, the idea that rates may be going up, the fact that inflation may be going up. Look at the Bitcoin gold chart lately. And since Iraqi freedom kicked off, they're like, whoa, why is Bitcoin holding up so well? Well, because it has a little more utility than gold, maybe a lot more utility. It's more transferable. Bombs start hitting my country. If I've got gold there, maybe not a great thing. I can't really move it.
Yeah.
And so what we're doing, aside from those frontier assets that, people are now maybe chasing, for the rest of crypto, especially the older, it's about fundamentals, to your point.
Yeah.
Cash flow, utility, regulatory certainty. And ultimately, we're in a position now where sentiment's bad, fundamentals are improving. Yes, we've got some geopolitical pressure, maybe some macro pressure. That stuff comes and goes. It's a really good place to be.
Yeah. Yeah, no, I mean, it is a great place to be. I feel like Ethereum still finds itself between a rock and a hard place. I saw Laura put out her tweet about Ethereum that definitely ruffled some feathers. People, obviously, Mr. Hoffman ruffled some feathers. Influencers, Ansem's like Ethereum's going to zero. Like, where do we, Santi said it's overvalued today again on the Blockwork show. What is your stance on like Ethereum, the network, and then Ethereum, the asset? Do you have a particular view that you're expressing?
Yeah, I don't like to put out price targets, but this is what I know. Bitcoin and Ethereum have done something very special and something that's really hard to do, particularly in the context of clarity.
Yeah.
And they've truly decentralized.
Yeah.
Right? That is their edge. That is their moat. Blockchains are going to come along. Some will be fast. 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 Some will be fast.
Some
We get deep. Deep, you know we get deep. Deep, you know we get deeper. We get deep. Deep, you know we get deep. We get deep. We get deep. We get deeper. You know we get deep.
Attend the Davos of Web3.
See you next year!
2nd and 3rd of June at the Louvre Palace in Paris.
Alrighty, guys, we are back. A little audio hiccup there, but Chris, we were talking about Ethereum and just kind of like how you're thinking about this asset class and also just generally like the framework going forward. I think another view outside of just Ethereum itself is kind of like thinking about the types of applications and products that are going to be, valued higher than others going forward. And I think there's like this common like apps versus infra concept, and also like this fat protocol thesis being kind of like disproven. But yet we still sit with, 90% of the top 25 tokens are L1s, stable coins, or some sort of like infrastructure. Maybe Polymarket comes out and has a huge launch and a token launch, and that does well. Maybe Hyperliquid kind of comes out, even if it's like a chain, it's an app, and it gets in the top 5 or top 7 or something. But I'm curious if you're looking at any kind of broader, like within the market itself, trends to identify undervalued sectors, or if you're a believer in this kind of apps to outtake the infra side, given some of these L1s are still valued very, very highly. How do you kind of reconcile this?
I think you can find value across the stack. Clearly, we found a lot of value in layer ones. We've found a ton of value in infrastructure over the last few years because we were building something, and so you need that foundation. We've seen a couple of really interesting apps over the years. I think now we're seeing, you mentioned Polymarket with prediction markets. Yeah. You're mentioning, there's DEXs, there's Hyperlink. So you can find value everywhere. I think when you step back and you look at some of the major themes, AI and crypto, very important. I'd also say start thinking about things like quantum. And these are 3 technologies that are absolutely correlated. They're going to feed off each other. Crypto is the democratization of finance in its purest form. AI is the democratization of information. It needs compute. Quantum is going to accelerate all of these things. And so I like looking at the intersection of these various technologies. Crypto at its heart is a very financial technology. We're putting private property into the internet for the first time. Like when you step back and you think about that for real, you're like, oh, wow, that's a big deal. That's probably why New York is the crypto capital of the world, because this is where global finance is. So you're going to see an incredible amount of innovation, an application like repo markets, things that just haven't really been cracked yet, uncollateralized lending. I'm a huge believer in fixed income markets. And so, I spent a career in there. Interest rate swaps, that's the largest notional product in the world, like $500 trillion. Almost nothing in crypto. And so we're not too late to the party. There's so much going on. I think those three verticals I talked about are going to accelerate each other. And I'm excited.
Have you tried the Venice chat product yet?
Yes. Yeah, so Venice is very cool.
I typed in like, hey, is this really private? And it was like, yeah, this is private inference. And I responded, I was like, that's fucking based, man. And then I wrote back like, yeah, it's pretty cool, isn't it?
Yeah, like things like robotics too. Like, so I know so many venture guys who are like, oh, drones, forget it. Oh, robotics, forget it. And then all of a sudden overnight, it's like, whoa, it's the hottest new thing, right? So you can't just like sleep on any of these verticals. You got to keep an open mind. On the venture side, it's always about founders, founders who are trying to solve problems and break walls. Like that's what you're on the lookout for.
Yeah. So I've got a decent sized position in Per right now, the DAT for Hyperliquid. And over the last like 6-ish months, it's outperformed by like 70 to 80% of the spot price. As of late, it's actually underperformed the last like 3-4 days. And I think they are hitting the ATM, selling shares to buy more hype. This was kind of like the original DAT like idea, and it kind of fell by the wayside throughout the last 6 months because this has just not been possible, and not even for Saylor himself. So that's why Stretch came about, because he needed more ways to raise capital. I'm curious if you have a right way to think about, for people who are looking at Hyperliquid right now, or Zcash or Bitcoin or whatever it is, how do you think about buying like a MicroStrategy or a Per or a Cypherpunk Technologies versus Bitcoin, Zcash, or Hype? How do you like allocate accordingly, and like what are the core differences to understand?
It's way too early to leave DATs for the dead. Okay. And we saw, like many things in finance, things get, you have bubbles, you have everybody racing to take advantage of a new idea. There's bubbles, and what you're left with are, there's going to be some amazing DATs that are very, very successful. And because when you step back and you think about the thesis behind a DAT, what are you doing? Well, it's kind of similar to an ETF in a way, because you're wrapping a security. And by wrapping something as a security, it makes it easy for anyone in the U.S. and in certain cases the world to access it. It's very operationally simple. I go into my brokerage account and I buy the thing, and I don't have to worry about anything else. Everything else goes away. There's a lot of value in that wrapper. And then, like an ETF or a token, what matters is underneath.
Yeah.
So if they're acquiring a token, well, you want to make sure that that token has good fundamentals. You want to see alignment with the foundation in many cases. It helps to have a KOL, key opinion leader, someone who's able to explain to the general populace why it makes sense. And we're seeing a lot of these DATs. They're not just investing in the underlying native token. They're investing in the ecosystem, and I kind of see a world where they become the labs of that ecosystem. Mm-hmm. They are the BD arms, right? Because they're the ones who are planting the seeds across that ecosystem to make it grow. And so, again, you have to do research. You have to understand the fundamentals behind. But I think it's a fascinating innovation. And I think for the right folks, the right underwrites, I still think there's a lot of upside for the right. But of course, like everything else we've seen, 90% of them are probably not going to work out. We're already seeing that happen. But there's some that are really, I don't think they're going anywhere, let's just say.
Yeah. But I personally wouldn't want Per to be doing anything but buying hype. Stake it, buy hype it, stake it. I know Tom Lee has gone out and bought, some stake in Mr. Beast company and has these moonshots and things, and that's amazing. But the only reason that I own Per is just because it's the capital that's in my brokerage account. It's just an easy thing.
It's easy, right?
Yeah.
It's much easier than figuring out how to buy hype direct.
But it also is,
and in certain ways, it's cheaper, right? The transaction costs are cheaper than paying through your nose on a crypto native exchange.
Well, that's the thing. Like Robinhood or Coinbase or anything, you get wrecked on fees, and then obviously you just trade on hype. Which
here's the good news: those fees I think are going to go to zero
across all the centralized exchanges.
Oh yeah,
because they're bad. They're really bad.
So the one thing I've learned over the years in markets is that spot prices go to zero. Spot fees go to zero. That's just what we've seen in equities. Why wouldn't it be the same in crypto? I mean, look what's going on in ETFs right now with Morgan Stanley. Yeah. Who was it who came out with a platform recently? Fees are going to go to zero. I think it was Schwab, cut fees in half from Coinbase. And so the one thing I've learned in markets after all these years is that spot trading exchanges, really hard business. All the money's in derivatives.
Yeah.
And that's why hype is really interesting. That is the prize. Did you know that, NYSE, right?
Of course.
It was bought by ICE. Mm-hmm. ICE is one of the largest derivatives players in the world. NYSE didn't buy ICE. ICE bought NYSE, but everyone talks about NYSE because it's so storied.
Right.
Money's in derivatives. Don't forget.
Right. Yeah. Yeah. Interesting. So let's talk about Franklin Crypto, what the initiatives are going to be there. Obviously, this is the institutional era of digital assets. I mean, it's very firm and clear. If you're not adapting to this world, you're going to die. This is the state of affairs, even to the extent that most kind of L1s and teams and blockchains are really focusing on this. And then you've kind of got a cohort of Base and Mega ETH and a couple of these others that are just we don't even care about any of that. We're just going to just do fully on-chain DGen consumer experiences. Yeah. But the bifurcation is very real. What does this mean for your role at Franklin Crypto and their role in this ecosystem?
Yeah, so I don't know if it's that bifurcated, to be honest. Okay. I mean, I did many years in TradFi, right? Built a bunch of businesses, and then I went full-time crypto for almost 5 years with my partner Seth. He's been, he's a little longer than me, and the team. And so we're bringing to the table deep crypto native experience. We've messed around and learned about every single failed consumer project. We've been in the trenches for the last 5 years. And so I think we've learned a lot through navigating, the thing in crypto is the highs are high and the lows are low. And we've been through all those cycles. We also learned how to operate in 24/7 markets.
Yeah.
And that's a rewiring that we had to undertake to be successful in the crypto space. And so we're bringing over to Franklin, very, very native expertise. But let me tell you about Franklin. Jenny Johnson, she's the CEO of Franklin Templeton. She came up through the tech ranks, and she grabbed onto this technology very, very early. They launched their initiative in 2018. So it's not like they're new to the party. And what I've noticed is the vision the ideals, it's all there, and it's perfectly aligned with where we're coming from being just crypto native, and they built this incredible foundation. Sandy Call over there, I actually sat next to her at Citi for years and years. I think we got into crypto together like 2013. She's a really good friend of mine. So we're coming across with this amazing foundation, and we're here to just scale, build. And it's interesting, it's such an important time because Franklin has clients all over the world.
Sure.
And they know that they need to get into this space. A couple of years ago, they had risk for being in here. We took the risk, we operated it, we survived, and maybe we thrived a little bit. But now they've got risk if they don't have a solution. And my job is to bring that together. Last thing I'll tell you is that institutions, they really like to take market risk, and they'll underwrite it because that's what they're good at. Token go up, token go down. Okay, it goes down. I understand. Like, that's what I get paid to do. Fine. They don't get paid to take reputational risk in the form of regulatory risk. If they do an investment and it gets hacked and you're like, too bad, so sad, there goes your money. Like, they're not comfortable with those risks. And so as I'm talking to, the Franklin team, and I talk to the lawyers and the compliance folks and the vendor management and the cyber folks, that's a huge part of the differentiation that a storied institution like Franklin brings to the table. And I mean, I couldn't be more excited, man.
Yeah. And so your firm bringing this kind of expertise, this, decade in the space, understanding how it works. I had a guy in here a couple days ago from JP Morgan, and he's like doing this special division, and his biggest thing was like, I'm just trying to talk to people to like understand what the hell's going on here, because like that is the most valuable like insight, right? And like, I'm not going to say that something like XRP isn't worth 145 billion, but like, I'll tell you that I, am more interested in this than I am in that. And that I see value in this thing, even though that the mainstream adopts this idea. And like, here's why, and it just, maybe it's my subjective opinion that's biased in its own way, but it's like, here's what I've learned over 8 years in the space. Yeah. Here's what I think matters. Here's where I think this is going. And so I think like that is like an invaluable, trait to bring to a large institution who, as you said, isn't late to the party, but the on the ground expertise, the day by day, the kind of in the trenches, so to say, is I think a lot of these firms are going to be, looking to acquire that.
Yeah, I think try to serve as a Rosetta Stone, right?
Right.
Came from that world, built businesses in that world, ran 3 global businesses, been in the other world. How do we translate? And what you really need to translate is utility, right? This is why this technology matters, and you can talk about it in their voice. You see, we can eliminate Herstat risk in your FX business. Oh, really? Like, and people are like, what the hell is Herstat risk? Well, it's settlement risk. It's a fancy way of talking about a bank that went bankrupt in 1974. We can translate that for them. And also, the really interesting thing happening right now is, remember back in like 2018, it's like blockchain, not Bitcoin.
Yeah.
Right? You're seeing both now. You're seeing blockchain getting integrated to address those things like Herstat risk, to help facilitate 24/7 markets, things that institutions are desperate to have to survive. But they're also starting to recognize that I can't divorce the blockchain from the crypto assets as well. And I think there's a lot more focus now on understanding the fundamentals of those assets. And they're starting to blend together with other assets. Like, in a very simplistic view, you can take a token and you can wrap it and you can make it tokenized equity. And you're unlocking 24/7 market, instantaneous settlement. You can wrap native assets well. And it's kind of very similar, but it's what's underneath, man.
Yeah.
And so there's that light bulb is starting to go on. And the other thing is, like, the big boom of 21, a lot of banks and institutions started their little digital asset teams. Yeah. Boom happens, all that talent left. Well, since we've been in a bear market for a while, those digital asset teams have been building in their institution because it's been a little bit nutty out in crypto land. So you have a lot of continuity now, and you're starting to see things come out of that continuity from the building perspective. So exciting times.
Yeah. I mean, I think one of the most exciting things about the latest happenings in the institutional verse has been not to kind of come back to my bags here, but hybrid ETFs launched, and then Bitwise and 21 Shares just slamming the buy on them as well. And so obviously it was people buying, but I think they also bought some of their own from their own kind of like fund or whatever their capital is, and so like a lot of us were excited about the adoption of the institutional landscape from these products and for these assets, but like a lot of us just want to see them buy what we've already been holding for the last 5-10 years.
Yeah, you want them to be your exit liquidity, right?
And I mean, that was the meme in 2017 was the institutions are coming, we're going to dump on them.
Yeah. But if you have fundamentals, you're really not dumping, right?
Exactly.
And,
I mean, that's
and I think maybe that's the dislocation is the natives we're going to dump on institutions. And you're like, wait a second. These institutions, they understand utility and fundamentals.
Right.
And so like, it's pretty hard to dump on because
they're
they
buying,
provide that they look at these assets through like very sophisticated fundamental research.
Yeah.
And so I don't think it's that easy. They're not suckers. They're actually very sophisticated.
Yeah.
And they know how to underwrite value.
Yeah. And you know what, like the part of that crypto is very appealing for people like myself and people in my generation is we look at the stock market, we look at the housing market, we look at the cost of groceries, we look at the cost of gas, we look at the cost of travel, you look at the any market in the world and it's like, holy shit, like this is my entry right now. 7,500 S&P is my entry, $30,000 NASDAQ, that's my entry.
Rates are high, hard to buy a house. Yeah.
And so you get into Bitcoin, you get into Ethereum, you get into Hyperliquid, you get into whatever asset you want to buy, and you feel like you have a chance to be like before, the older people buy it.
It pushes you out on the risk curve, right? Because you're trying to, look, when you're younger, you should take more risk, but I feel like for your generation, it's pushing you farther out on the risk curve because a lot of people don't have many other options, right? Yeah. They're taking a swing at the fence and they're going for it and they're hoping, and that's unfortunate. But look, I think at the end of the day, as time goes on, people will say, wait a second, I have access now. Like years ago, if you're up and coming, the only way you could learn about finance was through like on the job training, you have to learn from other people, but now you have AI and I feel like the democratization of knowledge, particularly in finance and other things, will help give your generation and younger a leg up because you don't have to rely on an older person to teach you or an intermediary to serve you because you can do it yourself. Like we never, it was much harder for old people like me to get access to information. So I do think there's hope.
Yeah. Chris, just kind of closing thoughts here. Are you bullish for 2026 for this industry?
Yeah, wildly.
Yeah.
Wildly. Does that mean that, we're going to hit all-time highs tomorrow? Well, maybe in Hyperliquid, which we keep seeing. And I'm not here to shill Hyperliquid, but I feel like we're in this really unique constructive environment where sentiment is not so good, fundamentals are improving, do your own research, connect with those teams, understand the asset, just like those institutions are doing. And I still think you can get in front of them because it's going to take a long time for them to understand the space. And I think, retail, other folks can be much more nimble, do the research and get in early.
Yeah, I agree. I'm not sure, it would be a surprise to me if Bitcoin went to all-time highs like sometime, in Q3, Q4.
You wouldn't be surprised, or
I would be surprised.
You would be surprised?
Yeah, but I wouldn't be surprised if it kind of, slowly chugs along sideways a bit, up a bit, and we get these pockets of assets that do.
Yeah, it's very hard to trade short term. Right? Who knows? Maybe tomorrow, Iran issues go away. The second the pressure in Hormuz comes down, inflation just drops down. Truflation calls it, whatever, and then rates are not going to rise. They're going there's so many things that could happen near term that it's very hard to predict and trade. There's a Bitcoin reserve that gets announced and it starts getting funded. There's so many short-term unknowns. And so it's very hard to invest through that lens. You have to step back and say, wait a second, here's what I'm seeing in the world. The world is really turning into a trustless, permissionless place. If only there was a trustless, permissionless asset. And so you have to step back, think long term, and then put your chips on the table accordingly.
Yeah, Chris, thanks for your time, man.
Andy, thank you, brother.
you joining
Appreciate
us. That's Chris Perkins live from the Tokenization Tower. Guys, we'll be right back with our next guest, Austin Barak of Relayer Capital, talking more about the AI and crypto thesis to wrap us up today. Don't go anywhere. It'll be a good one.
Money, power, and money, power, and we get deep. You know we get deep. You know we get deeper. We get deep. You know we get deep. We get deep. We get deep. We get deeper. You know we get deep.
Attend the Davos of Web3.
See you next year!
2nd and 3rd of June at the Louvre Palace in Paris.
We get deep. We get deep. We get deep. Hot. You know we get deep.
Money, power, and money, power, and
We get deep. You know we get deep. You know we get deep.
Oh my God. Oh my God. SEC delays plan to allow tokenized equities in the US of A. Oh my God. Oh my God. No. No. Just when you thought there was going to be a bullish weekend, the SEC rug pulls us. Markets are down on the news. No. We were supposed to get this innovation exemption this week. Of course, I mean, now who knows when it's going to come. SEC has delayed their ruling that US tokenized equities will be available in the US. Not great for the program. Yeah, that is unfortunate, guys. We really wanted to see that go through. If you're a bull right here, you wanted to see that go through. New type, SEC delays, stock tokenization, crypto following on the news. It is indeed. Yeah, man. Damn it. Oh, well, short-term fixations for long-term growth. We kind of needed a little bit of a pullback, a little bit of a reset before we can get going again. So the market will digest this over the weekend and we'll be all right. Guys, we're going to have Austin Barak of Relayer Capital join us now. AI Super Cycle episode number 34. Take a quick break, throw you to the animation for our lovely friends at Near, and then get the segment started. How to bring this up. Not the ideal news that we wanted to see on a Friday afternoon when we're balls to the wall long all of the crypto assets that would benefit from tokenized equities being available in the US. But that is what it is. We just got to pray this is Trump manipulating so we can get a better entry. I don't think Trump is manipulating my my $5 billion, $50 billion asset prices, but maybe we can hope. Guys, we'll be right back with Austin. Welcome back to AI Supercycle, our premier AI show, airing every single week, presented by Near. We cover the ins and outs of decentralized AI, privacy, and the future of this massive technology.
Near is the blockchain for AI and the execution of AI native apps. You can check out Near's latest AI product at near.ai. Now sit back, relax, and enjoy the show.
Ladies and gentlemen, welcome back to AI Supercycle episode number 34, our weekly premier AI show powered by our friends at Near. Visit near.ai to learn more about their AI tooling and their confidential Intense product, as well as their AI product powering the agentic future on chain. I'm with Austin Barak here in the AI Supercycle. Austin is the founder and managing partner of Relayer Capital, a thesis-driven crypto asset investment fund. Previously a partner at Coin Fund on both venture and liquid sides, brings deep expertise in protocol design, GTM, tokenomics, and more. Wharton Finance alum, not his first time on the show. Austin, welcome to the show, man. Good to have you. All right, we're gonna take a quick break, guys. One sec.
I can't.
Money, power, and money, power, and
We get deep, you know we get deep. You know we get deeper. We get deep, you know we get deep. We get deep. We get deep. We get deeper. You know we get deep.
Welcome back to AI Supercycle, our premier AI show, airing every single week, presented by Near. We cover the ins and outs of decentralized AI, privacy, and the future of this massive technology.
Near is the blockchain for AI and the execution of AI native apps. You can check out Near's latest AI product at near.ai. Now sit back, relax, and enjoy the show.
Alrighty, guys, welcome back to AI Supercycle, episode number 34, our weekly premier AI show powered by our friends at Near. Visit near.ai to learn more about their product suite. Today, we've got Austin Barak on his Venice Grass, Near, and AI thesis. Austin is the founder and managing partner of Relayer Capital. Guy's been absolutely dialed in on the timeline as of late. Good to have you, Austin.
Yeah, really glad to be here. A lot of interesting things happening in crypto land these days.
There is, man. There is. Man, let's just start, man. I used Venice for the first time a little while ago. We had Eric on the show in February at NearCon, and I typed in like, "Hey, is this really private?" And it was like, "Yes, the inference is private." Blah blah blah. And then I wrote back. I was like, "That's fucking based." And then it responded back, and it was like, "Yes, it's pretty cool, isn't it? With Venice, you have this." And so like, there's kind of like this really cool first moment when you use Venice, and you're like, oh wow, all of my chats that I've been using with the typical providers are so not public, but the data is going to the large providers, and all those deepest, darkest diary rights or freaking whatever it is, business secrets, plans, etc. And so, give us your private AI Venice kind of high level view here, market structure, thesis, founding team, and let's start here.
Yeah, so Venice is really interesting because they've gone through so many different iterations over time. And I first came across the project January of last year because I was really big into virtuals and AI XBT. And a lot of the initial airdrop went to holders of tokens in those ecosystems. So that's when I first came across it. And it was really, interesting product. But AI, and it's wild that it's only 16 months or so, but AI wasn't as ubiquitous then in terms of just a necessary part of everyone's daily life. And over that period of time, we've gone to the point where whether it's Claude or ChatGPT or another service, it's not only, it started off as supplanting Google search, like, oh, I'm going to just search whatever query I want on an AI platform using an LLM instead of Google. But now it's around creation. It's around solving tasks. It's having a team of people around you and using agents. And what I think people are realizing over time is that in AI, more so than anything, privacy is incredibly important, because you're sharing your health data, you're sharing your financial data, you're connecting all of your files, you're sharing your entire life in a way that you haven't before. Because in the past, people were like, oh, how do I think about privacy in the context of social media? Do I have a public or private profile? Does Facebook have too much information on me? And this is not like 10 times more data using AI, it's 100 times more data. And what's really, really cool about Venice is it's not about just having AI usage in a private context. It's about not sacrificing user experience at all, and actually improving the user experience, because instead of being wedded to one model where it's like, oh, I'm using ChatGPT and I'll use their models as they upgrade, or I'm using Anthropic and the different models as they improve over time, or Gemini or otherwise, or the different open source models, you can use the right model for every task, and you can select which models you want, so you can be as custom as you want. So what they've built is, first of all, a consumer product that's just really, really, really good. And most of their users don't know anything about the token. And then the token has this added element on top that's really cool. But I think that's and I'll stop talking in a second, but you can tell I'm very bullish on what they're doing. You have this situation where, and this is where I think consumer products are headed in crypto, where the token can be a really important part and like supercharge the experience. But for the majority of users, they don't need to know about the token to find it useful.
Yeah, I mean, that's like the breakthrough of consumer product crypto underneath, but it adds this kind of like interesting element. People are actually comparing it to like Luna, and this like staking to get this DM token, and then you have like this debt with your inference that you get, that you get to buy into by staking the token. And people are having issues with the token dynamic right now. I'm curious, Austin, what is the right way to think about the Venice VVV token and DM token as they exist in the current Venice flywheel? And then kind of take us through some of like the revenue side as well of Venice, because they are doing some buybacks, but not a ton. How do these two tokens work, and why is it not like a Luna?
Yeah, so they have 3 million users. They just announced that, and they're growing incredibly quickly. So they got 1 million users in the last 3 months or so, 1 million 7 months before that. So they're constantly accelerating. They have two tokens. So they have the VVV token, which protocol revenue is used to burn VVV, but also you can also stake VVV to get a free membership. But the most interesting part is you can stake and lock VVV, and that allows you to mint a token called Deem. You can also buy Deem in the open market, but you can stake VVV and mint Deem. And what Deem is for every Deem token that you own, you get $1 per day of free inference compute on Venice's platform. So you can think about it like a perpetuity where, over the course of a year, you would get $365 of compute, but it's use it or lose it. So it doesn't accrue over time. If you use 50 cents in one day, the next day you restart with $1, and the next day you restart with $1. And it's created this really interesting, almost like loss leader customer acquisition tool is the way that I think about it. Because unlike Luna, where you got to this insane amount of tokens outstanding and like billions and billions of dollars of stable coins, they are very, very explicit about boxing in what the potential cost of this is. So right now, the amount of Deem that you can mint per Venice token declines as more is in circulation, and creates more or less a hard cap around 38,000 Deem. So at the current point, if all Deem was locked and used for inference, because if it's freely circulating, if it's in an LP pool, if it's not in that system, then you're not earning the $1 per day. You just have that asset that could earn the $1 per day. But if all of it was being utilized, that's $38,000 per day maximum of cost to Venice, and that's directionally $10 million a year. And it can't be more than that. Right now, about 10,000 Diem is being used per day for inference. So that's about like a 3.5 million annual cost. And that's offset by the fact that they have pro subscriptions, premium subscriptions that range from $18 a month to $68 a month to more. And then as people use the platform, they purchase tokens and purchase additional credits to use the models. They've grown from a couple billion daily token usage to, as of recent count, 70 billion. So done like a 15x in the last couple of months. So I would say the way it's different here is there's a maximum potential cost to the company, but by people using Diem, they're also using subscriptions. They also purchasing other credits if they need more than the dollar per day per token. So it's very easily covered by the revenues of the business, and well exceeded by the revenues of the business. But what is really cool about it on the other side, like, how is it potentially Luna? And I think it's clearly not. But the really cool part is you can guarantee access to compute in the future. And right now it's valued at like a 20% discount rate at around $1,800. I think something like this should be valued more or less along the lines of like corporate bond. So say like 8 to 12%, which would put its price a lot higher. Just, as an example, 10% would put it at $36.50. When I started looking at it, it was valued in the $200 range.
It was $200.
Yeah, and I was thinking like,
about it.
Yeah, and I'm like, there's no way that something that's producing $365 a year should be worth $200 unless people think that Venice is just not going to be able to support it. So at that point, it was a no-brainer. I still think there's room to run, but on the economic side of Venice, outside of Diem, the numbers are staggering, and unlike anything that we're even seeing in crypto, it's kind of like growth rates that you're only seeing in AI, which is why it's so compelling.
And so you're a pretty firm believer that I think Venice tapped almost $20 today, the actual VV asset. You think this $1.5 to $2 billion range is firmly undervalued for VVV?
Yeah. So when I first started buying in January, it was like, about $2.50. And
that's when we had Eric on Feb.
Yeah, it was, Eric has consistently been ahead of the curve in everything that he builds, and I've been following him for a long time. So that made this investment a lot easier because he's proven himself time and time again. But at that point, they were doing a couple billion of tokens a day. Now they're doing 15x that. They had about, maybe like 1.5 million total users. Now it's 2x that. They are, by my estimates, probably doing 3x or more the amount of revenue that they were doing before, and likely trading the like 20 to 30x revenue range for a company that's growing, I don't know, like 20% month over month, which I think is still incredibly cheap. And you compare it to an open router, which is worth the same valuation, doing similar amounts of revenue, maybe less, growing perhaps not even as quickly. And the difference here is they own the customer. It's not back-end infrastructure that's plugging in. People that use Venice are using Venice every day. I mean, that's the only way that I use AI is through Venice. And yeah, I think there's a lot of room to run here.
Yeah.
And of course, none of this is financial advice.
No.
Just my personal opinion.
So I haven't been up to speed on Grass at all. You've been harping on this one for a while. It looks also ready to fly. I'm sure it's pulled back a bit today, whatever. $50 million or more of annualized revenue, accelerating triple-digit growth. What is the premise of Grass? How does it make money, and why is it compelling?
Yeah, so for Grass, they collect data sets and sell those to frontier AI labs that need that data to train new models. And these labs are generating new models at an incredibly rapid pace. But in order to generate those new models, they need more data. And it's not just like random scraping of the internet. It needs to be very specialized. It's very specific data sets, and it needs to be high quality. So that's the role that Grass is filling. And because there's such an incredible amount of spend around building these models, Grass is a beneficiary of that because then there's just a larger and larger demand for data. So the team there has been, building for years. I think they did like $3 million in revenue in a quarter at one point last year. By the end of the year, they did 12 million or almost 13 million in the quarter. Based on my estimates, they're growing even faster, and they're going to have their token holder call in the next month and a half. We'll get more information. But this is something that is showing triple digit growth. It's 50 million ARR or annualized revenue based on the last numbers. I expect they're probably closer to 80 right now, and it's valued around 400 million. So for something that's growing so quickly to be valued at 5x just makes no sense in my mind, and is a really good candidate to re-rate.
And does Grass have any working relationship or anything to do with Venice at all?
They don't at the moment. Venice is generally not building their own models.
Right.
So yeah, there's no relationship at the moment. Who knows down the line. But I look at it as like two interesting different sides of the equation, where it's one is how do you use AI and how do you use it in a private way, and the other is how do you build the models in the first place. And Grass and Venice are tackling both of those sides.
And so Grass at 5x of revenue is, some of these things in crypto trade 20, 30, 40, 50x revenue. So you think like the $400 million range is a bit of a no-brainer?
Yeah, and I think a big part of it is like there's other things in crypto that are trading at like relatively low multiples, but they're not growing. And people come to crypto because they want to invest in growth. So I think a lot of those examples don't necessarily hold water because there's just not the flows. But for something like Grass, that's one of the best examples of something growing so quickly, I think it merits attention just on that basis, let alone the fact that it's, in my opinion, fairly cheap.
Yeah. Okay. Do you have a thesis on Near at all? Have you been paying attention to Near?
Sorry, say that again.
Do you have a thesis on Near? Have you been paying attention to Near?
Yeah, I've been following Near. I think Near is an interesting one, even outside of the AI component, because they are the infrastructure that's powering so much of cross-chain swaps. And we saw that, in October and November of last year, gain a lot of tension with swaps for Zcash, right? As people were going in and out of Zcash. And Near Intents, while useful and probably one of the best cross-chain experiences for swapping, it also plays a really powerful role for agents because it's, in my opinion, one of the best pieces of infrastructure to plug into to do cross-chain swaps, where you don't have to have all of these other dependencies. And they're seeing that grow really quickly. I think right now it's like, if you're an L1, somebody tweeted this out earlier today. So I'm like, I thought it was so well said, but I'm repackaging it, and I don't want to not attribute credit. But it's essentially like, you need to be a vertically integrated app experience. You need to be 10 times better at something, or you need to be like really, really, really good at one type of application. And I think Near is just absolutely crushing it on the intent side. And they're doing a lot of other things on like confidential intents, other elements around like AI usage. But they're one of the L1s that's really found their place. It's like an NBA player, and all of these new L1s and L2s are coming to market, and they're the really interesting rookies. And, over time, some become the superstars and some just kind of like fade away. But then you have the role player that's just really, really good in their role. Like, I don't know, like Lou Dort on OKC or Alex Caruso or whatever. And Near feels like one of those players where, it's not LeBron James, but they're really important because they're just so good at what they do.
Yeah. And it's also like sitting in the middle of like this privacy AI thesis, which I think is like really obviously gaining traction. Another one that's been slept on that Robbie has been harping to me about, unfortunately he's not here today, is Akash. and how they were so early to this kind of like distributed inference, distributed models, this kind of like decentralized training, right? That was like the first iteration of crypto AI. Then we had like these like Fugazi agents with like the meme coins, and now we're on to like the next iteration of the decentralized inference models training, but like with like far superior products. Have you looked into Akash and what they're doing? Do you have a thesis there?
Yeah, I've definitely looked into Akash. They started off with decentralized CPU marketplace and then GPU marketplace, but you can actually check on the amount of data that's running through OpenRouter. A lot of that is going through Akash, which is the Akash ML, which is very cool to see, and that's just public data. But yeah, I admittedly am not it's not one of the names that I'm following as closely, but it's for a team that's been around for a really long time. It's constantly iterating. It's very cool to see them find real product market fit right now. That seems to be accelerating.
Yeah, and I'm just going down the list here. There was a company called GitLab. I don't know if you've seen them. They're like a very low cap on base, and they're crushing the amount of tokens in production per day as well. And there's this kind of new cohort of like highly speculative AI tokens on base right now. And there's like so many little niches to understand in the puzzle here. And so I guess like not to ask about kind of like low caps or, what you're seeing there, but more like broadly, is there a specific part of this stack that you think is most ripe for massive growth when you can apply like the blockchain rails to it? Clearly, we've seen private inference and uncensorable ChatGPT with Venice. With Near, it's kind of like this agent marketplace. With Akash, it's this Akash ML, Grass, the data sets. Is there a couple like key sectors or parts of the AI stack that you think investors should look at for being meaningfully replaced or usable when it comes to like applying them to the blockchain context?
Yeah, so I think you have the privacy context around private usage of LLMs as well as uncensored usage. You have the data collection side to trade models, which is Grass. You have inference and compute, which you mentioned Akash. We're seeing other inference marketplaces pop up. There's one that's actually building around Deem as well as other services that allow you to sell your spare compute, and that's called Anseed. That's been an interesting one that I've been following. There's no live token yet or anything, but that's one that I think has been doing some cool things. Particularly aligned with Venice and Deem. I think there's decentralized model training as well in terms of how can you build open source models that also have the ability to retain ownership and monetization by using private weights. And there's a couple that are building in that sector. Pluralis is one of the ones that I think is most interesting that's building there. There's Noose Research that's doing some really interesting things with Hermes. And you have Prime Intellect, a couple others. So I think like the decentralized training, the inference and compute marketplaces, the infrastructure around agents, the data, and then just like the consumer application of model use is the main areas that I'm looking at.
And then, Austin, I think like there's this AI thesis and, covered a lot of like the big names here, but there's also this other thesis that you've been, just pounding on, which is there's this new way to think about token models and economics. You've been a big proponent of like Aerodrome or Hyperliquid. I'm just curious, how do you think more broadly outside of the AI context as we kind of come to a close about this net token value flows and thinking about like credit and debits and how like the industry is evolving in their thought process, specifically around analyzing token economics and the right mental model for assessing the plus and minus or the credit and debit of a given crypto asset. What is your current framework for this? And like, do you agree that investors should be thinking about this like a credit and a debit, like a plus and minus sheet? How do you kind of think about net token value flows?
Yeah, so I think there's a couple ways, and one, it's not one size fits all, because let's start, at a high level with buy and burn, and that's something that Hyperliquid has made really popular, and everyone's like, well, look how good Hyperliquid is doing, and they have buy and burn, but for every one Hyperliquid, there's 9 other tokens that have the same buy and burn, and their token price has been horrible. And what's the lesson there? It's Hyperliquid is a great business, hence people like the token, and buy and burn is how they deliver value to token holders. But if it's not a great business that's going really well, your token's not going to just go up because you do buy and burn. So that's the first thing that I think people conflate. The second is, are you driving value to token holders? So whether you're doing buy and burn, buy and distribute, whether you're even just reinvesting in the business, having money in a bank account to give yourself more bank balance sheet flexibility, do the token holders maximally accrue the value of what's being built? And that's the case with Hyperliquid, that's the case with Aerodrome. For all the wish that a lot of people have that Grass did more buybacks, it's very clear all of the all of the contracts are signed with the foundation. All of the revenue goes to foundation bank accounts. All of that is controlled by token holders. So I think there's a lot of different ways of thinking about it. And then it's a matter of token flows. So, Hyperliquid has a theoretical maximum of how much could be unlocked every month, but really it's like 200,000 or 300,000 tokens. And the amount that's being purchased from the ETFs, from the DATs, from the assistance fund is much, much higher than that. So naturally you have more buyers than sellers. Something like Aerodrome, if you lock Arrow into V Arrow, soon to be called S Arrow when they do their ETH mainnet expansion in July, you're earning all of the revenue from the platform, and you're directing emissions to the relevant pools where you think it's most important for there to be liquidity and where you're going to generate the highest revenue. And they're like, well, if in a given period the value of emissions exceeds the value of revenue, then it's net negative, or it's net negative earnings. And I think that's really the wrong way to look at it. The way to think about it is how much is being earned as revenue versus how much is freely circulating afterwards and not being sold, because you have they recently changed the name to the Momentum Fund, but you have kind of essentially the foundation that's doing buybacks all the time. You have people that are earning Arrow that are locking it every period to stake it to earn the revenue. And then you also have people that are just bullish on the token and are not selling. So when you think about it on that basis, every single epoch, so every single week, there's meaningfully less tokens that are going to the open market than the amount of revenue that's being generated. And then when you factor in recent launches, like, there was the Atlas Aura and others, at this point, Aerodrome is earning meaningfully more revenue, and when I say Aerodrome, I mean token holders, than is actually coming out as emissions. So I think for every example, you have to look at it in a nuanced way, but at the core is, do token holders earn the value of what's being generated? And then you can start to iterate from that lens.
I think the entire industry is shifting into a similar mental model. As I said, it's very nuanced, but it's like we have two emerging things happening right now. It's like these revenue fundamental companies, and then these more narrative niche, very useful technologies, Zcash, Venice, Near, these kind of very niche AI privacy things, and then just pure businesses on chain. And in the middle right now, there's just not a lot going on.
Yeah, no, and I think that's right. And one of the interesting things about this market is there's a smaller set of interesting tokens because people are a little bit more realistic around what's finding traction, what's real in the moment, and not just hype. And not, and when I say hype, I don't mean Hyperliquid, but I mean what's euphoric, dreamlike excitement. And there's maybe 10, 15, 20 tokens that have really, really strong fundamentals. So I think for that reason, we're seeing those tokens meaningfully outperform the market, because for the first time in a while, you are able to pick from a much smaller subset. So all of the flows are going to the things like Venice, like Hype, like Grass, like Arrow, like Near, like Zcash, which is another one on the privacy side. Because, people are, I think, a little concerned that Bitcoin's becoming too impacted by Sailor, and that's like a whole nother conversation. And that Zcash is the original ethos of Bitcoin with the similar structure. And Zcash, while it's doesn't have revenue in that context, it's an interesting asset because it becomes more useful the higher the price goes, because then it has the higher likelihood of being entrenched and having consensus community value around it. So yeah, we're in this really interesting place where it's getting a lot easier to bid the right coins. You just need to be a little bit more channel your research into what's real and what's not. And for people looking for the 5 to 10x or the 3x, you're much more likely to get it than trying to get the 100x, and maybe you get the 100x anyways. But I think there's a set of businesses that are doing really interesting things, and those are the ones that I'm anchoring to.
Yep. No, I mean, it's it's easier if you are disciplined and just stay in the lens of what's working and what's going up. And I mean, today's been a bit weird, but you zoom out here, a lot of these things are, I think they're kind of buy, hold, and forget. Trust that you're in quality. Trust that you're going to do well. Austin, have a great Memorial Day weekend, man. Thank you for joining us in this episode of AI Supercycle. Been loving your content. You've been absolutely spot on last 6 months. So keep it up, man.
Thanks, man. Glad to be here. Talk soon.
All right, buddy. Have a great weekend. Alrighty, guys. Man, I don't know what's going on out there, but SEC was not too happy about that tokenization ruling. Industry is undergoing some structural change. Everything's maturing. There are a couple assets worth bidding, as Austin said, and I think it will continue to be that way. It's a long weekend in the States. We will be live back on Tuesday. Our episode with Arthur and Ilya is dropping on Monday. Ladies and gentlemen, have a fantastic weekend. Tell someone that you love them. Thank you so much.